Welcome to the Lend Academy podcast, session number 9. This is an extended edition of the podcast recorded on my recent trip to London, and I actually sat down with the leaders of the 3 top P2P lenders in the UK. They're all based in London. They're all actually within walking distance of each other. I'm talking about RateSetter, Funding Circle, and Zopa. So this is really 3 podcasts in one, where I'm giving you 3 separate interviews back to back. And we start off with Peter Behrens of RateSetter. He is the Chief Operating Officer and co-founder of RateSetter, and we recorded this interview in his offices. Okay, so I'm here in the RateSetter offices in London, talking with Peter Behrens from RateSetter. Welcome to the podcast, Peter.
Thanks, Peter.
Okay, so let's just start off with explaining to the audience here, what the RateSetter model is, how you operate.
So, RateSetter is it's a peer-to-peer platform, and we take retail investors. Our investors are retail savers who take their money and they lend it to individuals on the other side. So we're doing consumer unsecured loans of £2,000 to £25,000.
Okay, so and then what about on the investor side? Like, who's your typical investor?
Well, typical investors are it's very predominantly individuals, and they are, as a general rule, they are in their early 50s, or the average investor is in his early 50s. He's got a reasonable chunk of savings. We're not talking about high net worth people. We're talking about what we like to refer to as the mass affluent, people who are a bit wary of the stock market. They've been in it, they've dabbled in it, they find it volatile, and they want somewhere safe to put their savings money.
Okay. So then let's switching back to the borrowers. You said £2,000 to £25,000. Is that right? So yeah. What are the interest rates and what are the loan terms and that sort of thing?
So we do loans of 6 months, 12 months, 18, 24 months, and then 3, 4, 5 years. So okay. It's the general spread of consumer borrowing, if you like, in the short term. The average APRs, our absolutely best rates are down at 4.5% APR, which I suspect is a bit cheaper than you guys have got in the States. Mm-hmm. But the market in the UK is very, very competitive. And it goes up to sort of 12, 13% APR.
Okay.
That's the foreign.
So you don't, these are really then prime, super prime borrowers. These are people who, they have very, very good credit because you're not, if you're topping out at 12%, that's not a high risk borrower.
Yeah, there's not a lot of risk premium in there. Right. So no, you're absolutely right. It's a prime loan book. And the focus has very much been on a prime basis because we set ourselves up as an alternative to the world of savings. It's very much a safe, guaranteed return as opposed to a investment which has a riskier attribute to it. So we set up a safety net, if you like, which when we launched, we created this thing called the Provision Fund, which is a pot of money that exists to protect the lenders from the risk of default and to try to replicate the savings environment, to make it an easy thing for the consumer to understand.
Okay, so let's just talk about that provision fund. Can you explain how it operates? Because we don't have this in the US, and it's something that I've found personally fascinating. So as I see in your literature, you say that no investor, no lender has lost a penny at RateSetter since you guys started. So what explains what happens when a loan has gone into default that an investor has invested in? What's the process?
Okay, I'll come on to that in just one second, Peter. But I think just to articulate how the money goes into the fund in the first place, when a borrower takes out a loan, every borrower is categorized by us with their own risk criteria, and a fee is then applied to that borrower's loan, which they contribute into the provision fund. So it's how we rate for risk.
Okay, so it's almost like part of the origination fee goes to the provision fund.
Yeah. Exactly right. And that origination fee is flexed based on the risk of the borrower, which enables you to price the loans. Yep. So when we talked about having a variance in the APR, actually the flex is in the provision fund fee.
Okay.
And so what happens from a lender's perspective, if they've got a problem with a loan, is if the lender is expecting their monthly payment to arrive in the morning from the borrower, but the borrower doesn't make that payment, the provision fund will bridge that gap. It will pay the interest and the capital that the lender is expecting from the borrower, and it will pay that over to the lender, and the provision fund will then go and pursue the borrower for the missed payment.
So like even on the day itself that the investor is expecting money?
On the day itself, there is no time gap.
Wow.
Because if there's a time gap, you can't tell the lender he's had every penny. And we set ourselves up to deliver exactly what the lender expects.
Right.
Because our view at the time when we looked at the model, we saw that the conventional model is very much what you guys have got in the States, which is that when you're investing your money into a peer-to-peer platform, you choose the risk category that you're comfortable with. Our view of that was that we were trying to create a retail consumer platform that would be available to everybody. But we thought that was a bit of a complicated thing for Joe Blogs on the street to do. Mm-hmm. You know, you don't wake up in the morning and think, I'm going to have a bowl of cereal and today's a B-risk day. you have to, and you need a lot of financial education to make those decisions, which we felt limited the market we were addressing.
Right. So the investor cannot go and cherry pick the loans on your platform.
No. The lender arrives, he has two choices. Choice one is, do I want to lend my money for 1 month, 1 year, 3 years or 5 years? And choice two is, once I've decided that, do I want to try and set my own rate, or do I just go in at the best rate available in the market? And so we operate a genuine order-driven exchange, where you can put your money in at a price, and the market will either move to hit you or you'll not get your money lent.
Right. Okay. So you say you want 7%, then you might not hit as many loans as if you say.
Well, yeah, exactly. It might just take you longer. So if the market, for example, our 1 year bond conventionally trades at about 3%. So if you go and place your order at 5%, you're never going to get your money lent, because new money will perpetually come in and refill the market at 3%.
Right.
But if you put it at 3.1, actually the market might dip up one day and you might get your money lent. And it's about trying to gauge the demand that's going through the market. We try and make that information available to people.
Sure. So let's just talk about, you said you have 1 month product. So just explain how that works. And I mean, that's obviously, if you're saying that, no one's ever lost a penny and you've got a 1 month product, that's a really attractive proposition I think that'd be great for the US platforms. So how does that work? And I presume like people can then just, if you're saving for a house or whatever, you can go and throw your money in there and know you can get it back out at a month's notice.
That's exactly right. It's a very flexible tool. I mean, it's effectively a 1 month savings bond. So you put your money in on the first day of the month, and a month later you can have it straight back again with the interest it's earned.
So then you can automatically reinvest.
The system automatically reinvests it for people. So most people that put money into that monthly market leave it there for longer than 1 month.
Right.
But it works very well for people that know they've got a bit of spare money, but they know they've got something to spend it on in time coming up. Your example of the house is entirely the sort of thing that we see happening. We see people knowing they've sold a house and they put a bit of it in the rolling market, knowing they'll need to withdraw it in a few months' time when they're buying another one. And it's a very liquid and flexible tool.
Right. Okay. So let's just talk a little bit about loan volume. What was your volume in last year, 2013?
So we lent £104 million in 2013.
Okay. And what's your expectation for this year? And
do you want my expectation or my hope?
You can throw us out both if you want.
I think we should comfortably do 220 million, and I'd love to do 250 million.
Okay. So you're on the doubling every year kind of growth path, at least.
I hope so. I mean, at our current run rate, we're currently doing 16, 17 million pounds a month. So, that comfortably gets you to 180. So we don't need to grow that dramatically to get to the 220s, 250s from where we're at now. Right. So those numbers I've given you might be conservative.
Okay.
But I don't want to be talking to you next year and you said you'd do this.
Always good to be conservative, yes. So then what about, let's talk about your defaults. Obviously it's going to be reasonably low considering you've got the provision fund, but can you provide, what is your default rate to date? What is your annualized default rate? What are those numbers?
So what the provision fund has paid out so far and not recovered is 0.45% of what we've lent so far. Now, because as we just talked about, our rate of growth has been quite good over the last couple of years, what we've lent is a slightly disingenuous number, because that means that a lot of those loans haven't had a chance to go bad yet. So I think when we actually look at our credit data and we analyse how our book is performing, we think that bad debt number is going to come out nearer to 1.1%.
Right. Okay, that's fair enough. So on that note, then, you're obviously, these are really prime borrowers. I mean, that's 1% default rate is kind of an A grade borrower in the US. Are you, like, as you grow, are you going to find enough borrowers at that level? At what point do you think you're going to need to delve into a more risky loan pool?
I think for the time being, there are plenty of borrowers available to us. I think that the provision fund model enables us to delve into a slightly riskier loan pool. But what we want to do is make sure we grow cautiously and understand the credit as we do it. I actually gave a talk yesterday at a conference in which I talked about growth being good, but sustainable growth being a great deal better. And we need to make sure that we don't take any risks with our investors' money that jeopardize the premise of what we are trying to set out to achieve with rate setting.
Right. Good point. So are you guys cash flow positive, profitable? Where are you at in that?
Yes, we are cash flow positive and profitable, and we are, and have been since last year.
Okay. So then on the investor front, you obviously you've talked a couple of times about, this is a retail investor, these are individuals. Do you get much interest? Like in the US, we all know about how much the hedge fund community and the institutional investors are flocking to this industry. Are you seeing that in the UK or not so much?
Yes, we are seeing interest, and we're talking to a few people who are certainly interested in the space. I think one of the challenges in the UK up until now has been the regulatory picture has been a little bit more complicated for those institutions to get involved.
Right.
Because it hasn't been quite clear what they need to do to get involved. As the industry becomes regulated, which is going to be the case on the 1st of April, we're getting some sensible regulation coming in, which I think is going to make this picture a great deal clearer. And there are, as I mentioned, a couple of investors here who I think are going to make it happen and are going to go through the hurdles and the hoops, which will set a very clear precedent and a very clear path and make it a great deal easier for others to join the process.
So you are open to these larger institutions then?
We are open to them. I mean, I think we are very keen that RateSetter remains very available to the man on the street, because we believe strongly that diversity of funding is a very important thing, and we'd like to be a consumer business because philosophically we think we're adding real value to the consumer's life. Therefore, doing that for them is a good thing to do. But equally, we understand and acknowledge that institutional money comes with a great deal of advantages too.
Yeah. So, last question: are there any opportunities for US investors in RateSetter?
I think there are opportunities today if they can face doing some work. I think if they want to hold off for really not a very long time, possibly a few weeks, then I think there are definitely going to be opportunities emerging in the very, very short term.
When you say that, is that because of the regulations and because the different vehicles are going to come invest on your platform?
Yeah, I think so. And I think at the moment we're doing a lot of work here to understand the best way to make these things happen and the easiest way to make these things happen. And I think once we've got through that, and the point is we're going to get through there pretty soon.
Right. Okay. Well, great. Well, thanks for your time, Peter.
Pleasure.
Okay. Okay, next up on our tour of London is Funding Circle, and sat down with Samir Desai, who is the co-founder and CEO of Funding Circle. Now, keep in mind that they are unique insofar as they actually operate in both the UK and the US. But we sat down in their London offices. Unfortunately, Samir didn't have a lot of time, but I was able to record this short interview with him. Okay, so I'm here in the Funding Circle office with Samir Desai. Welcome to the podcast, Samir.
Hi, thanks.
Okay, so let's just start off with talking about the Funding Circle model. Can you just describe what you do for the US listener?
Yeah, so Funding Circle is a marketplace similar to Lending Club and Prosper that you're very familiar with that allows individuals, institutions, government, basically anyone to lend money directly to small businesses. We launched in the UK in August 2010, and we've lent around £240 million, so over $400 million in that market. In late 2013, we acquired a business called Endurance Lending Network, which was a US peer-to-peer lender, and we now operate in the US market as well.
So what are the differences between how you operate in the US and how you operate in the UK?
So the UK platform is available to anyone at the moment. In the US, we have a few restrictions on who we can accept. So at the moment, that's limited to accredited investors and institutions. In due course, we expect to launch a fractional marketplace in the US where investors can buy parts of loans. But at the moment, it's limited to a fund and a whole loan marketplace.
Okay. So then let's just switch to the UK. Like, who are your investors in the UK? What's a typical profile?
Typical profile of an investor in the UK is it really does range, but we have about 28,000 active retail investors. It's normally a 45-year-old male, slightly skewed in that way, right. But we have all ages lending, and on average they lend about £8,000 to over 100 businesses.
Okay, and what sort of returns are they enjoying?
So 70% of investors that are diversified across at least 100 businesses are earning over 6% a year, and the majority getting in the 6 to 8% range net of fees and defaults and everything.
Okay. So then what? And you're getting, like, talk about defaults a little bit. What are the default rates that you're experiencing now, and how are they tracking?
So the loss rate that we publish on the site, the overall default rate is about 1.4%. But obviously, with a fast-growing loan book, right. That number it's to some extent slightly meaningless. On an annualized basis, our loss rates are about 1.8% a year.
Okay.
And we're aiming for loss rates of about 2.2% a year. So we're well within the estimates that we publish. And what we found, in the same way as a number of US platforms, is that over time we've got better and better at credit assessment through better use of data, better use of models, and our loss rates are coming down. Right. All the time across cohorts.
Right. Okay. So one thing I just wanted to touch on that you talked about at the AltFi conference yesterday, you talked about you're tracking the businesses that you actually reject. And so how are you tracking them, and what are you learning from tracking them?
So we started Funding Circle in a very, very prudent way, and we continue to manage the loan book very prudently. So in the early days, we accepted a very small portion of the businesses that applied to us. Mm-hmm. And that's actually what we're doing in the United States as well. And what we've been able to do is build up a vast data set, not just of businesses that we've accepted, but also ones that we've declined that didn't meet our criteria. And through uses of databases in the UK, just general tracking of the whether a business has gone insolvent or not, and the other debt that they've been able to take out, we've been able to extrapolate and learn quite a lot more about whether we should have been turning down those businesses or not. But obviously that's kind of part of the secret sauce to some extent. But it has been a very valuable exercise. And one of the other things we've been able to do which is very exciting, is build a database that we call CODAS of every single UK business and layer on more and more data. And that's something we're looking to replicate in the US as well.
Okay. So do you think as you grow, are you sort of allowing more businesses that you might not have put on the platform when you first started? Are you getting a little bit more? You're expanding your offerings, so to speak.
Yeah, definitely. I mean, what we did in the UK in the second half of last year is we added a new risk grade because we had been able to model out a set of businesses that we felt were attractive and had predictable risk characteristics. Mm-hmm. And we expect to continue to be able to do that, over time in a very cautious way.
Okay. What are you getting right now? Do you feel like do you have enough investors? Do you need more borrowers? Where's the balance in the marketplace right now?
So it's different in our different markets. So in the US, I think we have more capital I would say, although we're starting to ramp up marketing efforts quite aggressively there, and all the signs so far is that market will grow. The US will grow much faster than we ever did in the UK. In the UK, we probably have a dearth of investors. We are putting in place mechanisms to allow institutional investors to start to lend here as well. But, because of and I think it's a high quality problem where, in both the US and UK, we're doing a lot more lending than we were targeted to do. And therefore we hadn't necessarily planned as much to get in as many investors as we needed to.
Right. So are you taking on institutional investors now, or are you just ramping up for that?
We are ramping up for that. In the US, we accept institutional investors at the moment,
right?
And in the UK, we will start to do that in over the next two months or so.
Right. Okay. So then, let's just talk about the future. I know you've got to go soon, but let's talk about you've expanded your brand. You're now becoming sort of the global SME lending brand. What's next for Funding Circle? I mean, are you going to be moving to new countries? What's the plan?
So, I mean, at the moment, we're very focused on growing the US market and continuing to grow the UK. Mm-hmm. As you said, we kind of feel that we're well positioned to become the global SME lending marketplace. There's some fierce competition from some very, very big names that I'm sure you're familiar with, mm-hmm. but I think over the past 4 years, we've built up a very good track record in credit assessment and a very good track record in being able to attract and market to these borrowers. So, the focus for the next 6 months is very much on growing the US and continue to grow the UK. However, we are looking at other international markets at the moment, trying to figure out how we can actually enter those as well. Our experience of the US has been very positive, and so that's given us an impetus to go to other areas. And then also just adding to the suite of SME products that we offer. So at the moment in the UK, we offer unsecured and secured loans to businesses. Mm-hmm. We'd like to offer loans specifically secured on property. And we hired a very senior person, a guy called Luke Juice, who used to head up real estate lending for small businesses at Barclays, to do that in the UK. And we're looking at other verticals, asset finance, equipment finance, that we can expand our offering into as well.
Okay, great. Well, thanks for coming by, Samir. Appreciate it.
Great. Thanks for having me.
Okay. Okay, last up on our tour of London is Zopa. Giles Andrews is the CEO there and a co-founder. They are the oldest running P2P lending platform in the world. They started in 2005 and Giles has been around since the very beginning and had a very interesting conversation with him. Okay, so I'm here with Giles Andrews, the CEO of Zopa in the Zopa offices here in London. Welcome to the podcast, Giles.
Good morning, Peter.
Okay, so we want to just give our listeners a bit of background. Can you just describe Zopa, how it works? We know that you were the very first P2P lender to launch, but just describe the model that you have.
So Zopa is a marketplace which connects lenders and borrowers. Lenders who have some spare cash, want a better return on that cash than is offered by traditional asset classes, I suppose, principally competing with savings. And we create better value loans for borrowers who we think have a very high propensity and likelihood to repay. So in the sort of horrible financial parlance, that makes them more prime than less prime.
Right.
But the basic model, the idea of the model is to provide great value to both sets of users. So better return on cash, on savings, and better value loans.
So then, who are your investors? Who's coming to Zopa to put them?
Well, so today, our investors are retail lenders, and with the small exception of one very large institution lending on our platform, which is called UK Government.
Right.
So with the exception of them, who've given us some money to lend in a very narrow niche of our offering, so lending money to sole traders for business purposes.
Right.
So the government had a piece of what's called a business finance partnership available for alternative lenders, but not for retail use. So we couldn't make consumer loans out of it.
Right.
But it represents a fraction of 1% of our business. So the rest of the business is exclusively funded today by retail lenders, who I think I can say confidently are viewing it as an alternative to a savings product in most cases. We obviously can't describe ourselves as a savings product because we're not a bank.
Right.
And we don't offer the FSCS guarantee, which in the UK is an insurance scheme. I'm sure you have some
we do,
done by the FDIC. Mm-hmm. which protects retail lenders from bank collapse. So it's not a savings product. It is not without all risk. It's not without any risk, but it conforms more closely to a savings profile than a more typical investment profile.
Okay, so people, let's just talk about the loans themselves. People borrowing different loan terms. What's the
loan terms are 2, 3, 4, 5 years.
Okay.
The average, you can borrow anything from £1,000 to £20,000. The average today is just about 7.
Okay.
And the typical loan use is to either buy something like a car or a significant home improvement like a bathroom or a kitchen, or to pay off more expensive credit card debt.
Okay, and what's the interest rate range on those loans?
Well, from as low as 4.5%.
Okay.
So the UK has become very, very competitive for large consumer loans in the prime segment. And that's been driven to some extent by previous bank action to provide very cheap liquidity to banks to make consumer loans, which they've stopped now, but there's still money washing through that system, funding very cheap mortgages and cheap consumer loans by banks. So we obviously haven't had any of that money, and our interest rates range up to the teens.
Okay. So who are you competing against apart from the other peer-to-peer lenders? What are the other options for borrowers?
Banks. So the UK financial services industry is much more concentrated than the US.
Right.
And personal loans as a category, which I suppose doesn't exist in an identical manner in the US.
No, it doesn't. Yeah.
But there's about £20 billion of new personal loans written each year. So it's an existing, quite large category. And 97% of that is written by banks.
Okay.
So there are no alternative lenders within that group. And when I say banks, there are 5 of them.
Right.
So it's incredibly concentrated. We also compete, obviously, against credit card companies. But in many cases, with a few exceptions, like the Capital Ones and MBNAs of this world, in most cases, the credit card companies are also the banks.
Right.
So again, a more concentrated competitor set than in the US.
So how do your rates compare with the banks for someone going to go a personal loan?
Typically, on a risk-adjusted basis, they're about the same or slightly cheaper.
Really? Okay.
So we aim to provide a price advantage. It's obviously hard when you move outside of the pure prime world, which is directly comparable because you can see it on financial aggregator sites like Money Supermarket, which is, I suppose, the equivalent of a bank rate.
Right.
.com in the US.
Mm-hmm.
Once you move out of that world into slightly less prime, it's very hard to compare apples with apples.
Right.
But our best intelligence is that we're typically slightly cheaper than banks.
Okay.
We also offer some advantages over bank loans that people can repay their loans at any time, either in full or in part, without any penalty. And that contributes to a sort of virtuous circle of attracting the most creditworthy people, because creditworthy people typically think they're going to repay their loan early.
Right.
And they know that there's a reasonable cost associated with doing so from a bank. And we've also, pleasingly, in won customer service awards. We won personal loan provider of the year 4 years in a row against the bank. So while we're using an innovative business model to deliver the loan, the actual loan product stacks up incredibly well, and our customer service in traditional terms wins awards against our competitors.
So that's got to help, because I was thinking, as we said before we started recording, you guys get a lot of great press. And do you find your brand has some awareness now in the market?
But pretty limited.
Yeah.
Some and growing.
Right.
But although we've been around for 9 years, we've never invested any money in building our brand beyond doing a lot of PR.
Right.
And so the brand awareness we have is a function of PR, press and broadcast. But I think over time, the business will start to invest more money in building its own brand through more traditional means.
Right. So then can you just talk about like loan volumes? What did you do last year in total loans?
So we did just under £200 million of originations last year.
Okay.
Which was up 120% over the year before.
Right. And what's your prediction for 2014?
We're targeting $500 million this year.
Wow.
Which is slightly faster growth than we achieved. Not significantly higher growth than we achieved last year. But our growth has been accelerating, which is what gives us the confidence that we think we can achieve that sort of volume.
Okay. And so on the investor side, what are the, like you say, you offer 2, 3, 4 or 5 year loans. What do the investors gravitate towards?
Well, there's some premium attached to lending longer,
Right.
Which I think is based on the pure sort of economics of bond yield curves. I mean, so people believe that interest rates are likely to go up. I wouldn't disagree with that. They're more likely to go up than down.
Right.
And therefore, there is some sort of premium for tying your money up for longer.
Right.
And I think therefore it just plays as a purely individual choice as to where you sit on that. So currently there's a premium of about 90 basis points for lending over 5 years compared to lending over 3.
Okay.
Our borrower demand is slightly higher in the 5-year world, and therefore hopefully our lender supply is slightly higher too.
And how are those loans performing, like 5-year relative to 3-year? I know you probably haven't had many mature, but you've been around a while. How are those?
So no, our credit performance is not very different. So we don't believe there's any greater risk associated with default.
Okay.
From writing 5-year business. I mean, interestingly, if you take the lifetime bad debt rate, predicted bad debt rate in the 5-year markets is slightly higher, which you'd expect because, generally speaking, defaults occur because something happens to someone, they lose their job or some other problem occurs in their life. So the longer the loan's out for, the greater the likelihood. So the sort of total lifetime expected bad debt is slightly higher. But then if you annualise that, which after all is the calculation you need to do to work out what adjustment the lifetime bad debt has on your annual interest rate,
right?
Then actually they're similar or slightly lower annualised bad debts in the longer markets than the short.
Interesting.
And you're probably aware from our stats, I mean, our bad debts are tiny.
Right, I was going to get to that. I mean, coming from the US perspective, we look at the UK, all of the UK, particularly you guys, staggeringly low default rates. Can you just tell the audience what your annualized or what your default rate is on your loan book annualized?
Well, so we reckon the annualized default rate on our loan book is probably about 50 basis points. So in other words, if you across the portfolio, the amount you'd have to price to cover the risk of bad debt is about 50 basis points. If you measure it in actual terms over the last 3 years, then our default rate's only about 20 basis points. Okay. But that obviously reflects the fact that more of the business, as we've been growing, as any growing credit business exhibits, if more of the business is more recent, it hasn't had a chance of default yet. Sure. So it's always slightly difficult to talk about what's happened in the last 3 years. It's a very small number. 20 basis points is a very small number.
So with that in mind, I was curious when you guys, you introduced...
I can just give you a bit of background as to one of the reasons why that is developed that way. So one, I think because we were the first people to do this in the world, we were really nervous or we were really, really anxious to try and create an impression of trust and solidity around the business. Right. So if you compare our offering in 2005 with, say, for example, Prosper's in 2006, where they took a completely different view, where they were keen to grow the business fast and aggressively, and actually, as many people in the lending business did in 2006, targeted the subprime world. Right. We didn't. We thought about it. I mean, there was a clear choice. Where do you want to target your lending? And we targeted the very prime world because we wanted to. While the idea of P2P lending might land as a bit weird to some people, lending money to strangers and expecting to get it back, we thought one of the things that would be helpful in growing trust in the sector would be that in the vast majority of cases, these loans repaid. And we all know from our sort of behavioural economics that we all react much more negatively to losses than we do positively to profits. Right. And what we didn't want was there to be a noise around default, and you wouldn't need very high levels of default to create a lot of noise, particularly since we diversify lenders. People would have been likely in their broad portfolio to have picked up defaults. Sure. Plus, in a new business, defaults require quite a lot of management, and they require quite a lot of infrastructure to chase up and collections and all that kind of stuff. Right. And we were keen not to invest that much money in that side of the business up front. So if you contrast that with someone like Prosper, who similarly didn't invest in that back end and suffered, I think, tremendously from the noise, from disappointing lenders, and perhaps disappointing lenders as much around what they then did or didn't do. Right. You were an early Prosper lender, so you're familiar with what I'm describing. And I think that was undoubtedly the right plan with hindsight, because I think it created a great deal of trust that we lent money to people and they repaid it. We also have a tax problem in the UK, which isn't mirrored in the US. And the tax problem is that a retail consumer lender can't offset losses against the interest they earn. Right. And if you look at lending in a very prime space, say you're lending at a gross return of 5%, you pay tax on 5%, and then you suffer maybe 10, 20 basis points of loss, it doesn't really matter. You're wasting the tax, if you like, on that 10 or 20 basis points of loss. It's not really significant. If you move into the less prime world and say you're lending money at 15% and you're paying tax on 15%, you might be a high rate taxpayer paying 45% tax. So that takes you down to 8%. You could easily have credit losses of 8% and even 9% on a 15% loan.
And you can't deduct those losses.
So you're then left with a positive pre-tax return and a negative post-tax, or low or negative post-tax return.
Right.
So that very much steered us down the route that actually, apart from a very small segment of the population who doesn't pay tax, retired people perhaps, or actually it didn't make economic sense for Zopa lenders to be lending in riskier markets.
Interesting. I haven't heard that argument. That makes complete sense. So the one thing I want to talk about is you introduced the Zopa Safeguard last year, which is sort of the provision fund or whatever for protect lenders against losses. The question that I always want to answer is that if your default rate's 0.2 or say the annualized 0.45, was there a demand for that?
No, there wasn't.
So why do it?
Well, I think so. Our existing customers, there was no demand at all for it. However, I think it makes a description of risk easier for new customers.
Yep.
And actually, ironically, the main reason we launched the Safeguard product was to solve the tax problem. Right. So it was the enabler to allow us to move into slightly higher risk lending without penalising our lenders, because the lenders are getting a net return.
Yeah.
And therefore the amount they get is the amount they're taxed on, and you solve the tax problem.
Right.
Now, we've been campaigning for the tax problem to be solved in more traditional ways. I changed tax legislation for some time, and I'm optimistic that at some point that will happen, but we weren't prepared to wait for that.
Right.
So that was a main motivation for launching Safeguard. And another one was to reorganise the way the marketplace works, and to, in our view, make the marketplace more efficient. Mm-hmm. And prior to Safeguard, it was very natural and reasonable for consumers to say, I only want to lend into that market. And it might have been one of the high-risk markets, or it might have been one of the low-risk markets, because that was their choice. And they may have said, I only want to lend in the very low-risk markets because I'm a high-rate taxpayer.
Right.
And it doesn't make sense for me to lend in that. Or maybe I'm actually just very, very conservative, and if you show me the safest thing I can do on your platform, that's what I want to do. And then maybe some other people who said, actually, I want the most exciting return I can get on your platform. And actually, what that meant was that capital gets allocated on the marketplace with no concept of actually where the demand is.
Right. So why wouldn't everybody go to the high risk pool then, if they're going to have if they're protected from the? Well,
so that's the point. So by creating Safeguard, you're saying to the guys who are both taxpayers or higher rate taxpayers, even worse, or the most conservative, we're saying, right, there's no reason for you not to lend in the high risk markets now, right? Because we've solved that problem for you. So then the next obvious thing is, right, so everyone's going to do that because there's no increase in risk. So therefore you have to stop them doing that.
Right. Okay.
So what we did in Safeguard was take the opportunity to say to our lenders, we will deliver you a blended return from a basket of loans. Okay. And we will manage, we believe, more efficiently the allocation of capital to the markets where it is demanded, rather than relying on lenders to do that with imperfect information. And there are times when markets actually can work more efficiently with some intervention around where funds are allocated best.
So then, can investors opt in or opt out?
No, because it only works if they can't. Because if they have the opportunity to opt in and out, then that leads to potential gaming.
Right.
So the Zopa, another actual motivation behind all of this, and the two were sort of very much thought of together. Safeguard wasn't developed in isolation, just as simply a Safeguard fund. It was developed as a tool that allowed us to reorganise the marketplace, and that's why it actually was quite a big project rather than just a very simple fund structure. Right. And why we think actually it's so innovative. And it works on the basis that everybody does it, but it also allowed us terrific opportunity to simplify what we do to the outside world. There's huge amounts of evidence in across all types of e-commerce that choice actually is a burden to consumers and typically lowers conversion. Right. And what we found since we launched Safeguard was that the recruitment of new lenders went up and they funded more money. And we don't think that's because we took away risk. I think a lot of it's because we made the thing so much easier.
Right.
So the choices you have when lending one's open now are, do you want to lend in up to 3 years or up to 5 years? Do you want to reinvest your funds as they come back, as repayments come back in? Do you want to automatically reinvest them? And how much money do you want to lend? And that's it.
Right.
So the overwhelming evidence from users is that they think that that's a far simpler and more straightforward process.
Right. Interesting. So then that sort of segues into my next question, which, when we chatted 2 years ago for an article on Lend Academy, and at the time you said you were very much focused on the retail investor and you didn't see the institutional investor really be playing much of a part. And at the AltFi conference a couple of days ago, you said that you're now open to institutional investors and welcoming them. So what changed, and how, and obviously, are you still focused on the retail investor?
So in some ways nothing's changed, and in some ways some things have changed. So the thing that hasn't changed is that I believe, and one of the major reasons for creating SOPA in the first place was to provide a better financial product for retail consumers. Mm-hmm. So we believe that retail consumers in this country are really badly served for their opportunity to invest in financial products, and probably worse than the United States.
Right.
So the asset classes that are available to retail consumers in the UK are putting money in a bank in a variety of different flavours, either instant access or some kind of savings bond, but call it a savings product. Buying stocks and shares, and UK consumers are far less likely to directly own stocks and shares than Americans. So the man on the street doesn't typically own any stocks and shares directly, might indirectly through a company pension scheme or something like that,
right?
But doesn't go out and buy British Telecom shares on the whole. And thirdly, their house. And they're the three big asset classes. There are all sorts of other asset classes available to high net worth and sophisticated investors, but that's not who we built SOPA for. We thought there was a glaring opportunity, a glaring hole for someone to get a better return than offered by banks that's less volatile, less scary, and easier to understand than stocks and shares, and less hassle than buying another house.
Right.
Because actually the number of people who buy to let property is pretty low. So I believe strongly that the platform should remain very strongly retail focused, and I think that ultimately leads to a more interesting business, and potentially a more valuable business. What things that have changed are 2 years ago we were growing relatively nicely, but sort of probably slightly less than 100% a year, and through PR we were achieving, and general sort of organic growth and recommendation, not through any marketing, because we've never marketed to our lender base at all. We were recruiting lenders at least as fast, if not faster, than we were recruiting borrowers. So the supply-demand balance was slightly in favour of retail lender capital. So the priority was to grow the borrower business and, if you like, catch up. I think what's changed is that we achieved that priority.
Right.
And we grew faster last year than we have any other year since, the early days of the company, the very early days of the company, where you're growing from nothing. So any growth looks very, very high. And we managed to grow the borrower base slightly faster than the saver base. Mm-hmm. And we're now in a sort of state of probably quite close to equilibrium. But we believe we could lend more if we could grow the capital side of the business a little bit faster. And I think institutions can play an interesting role in helping us do that. I think another thing has changed, which is that the yield requirements of institutions has come down in that 2 year period, perhaps driven by the global financial situation and the lack of yield generally in things, and also perhaps driven by our friends in the United States, who've done a terrific job in showing institutions that this is an interesting asset class. So they've done a lot of hard work, if you like, in educating people and making what we do seem more interesting and more appealing. So I think the opportunity to recruit sensibly priced institutional money is now greater than it was when I spoke to you 2 years ago.
Okay. So are you primarily looking at UK-based institutional investors, or continental Europe, US? Who's coming to you?
People are coming to us from all over. It is easier for us to deal with UK money, and that's for all sorts of boring tax reasons.
Right.
It's so we currently have a requirement to source money from a UK entity. It's certainly not beyond foreign institutions' abilities to set up UK entities in order to do it, and a number are considering it.
Right.
But we would have to, as it stands at the moment, withhold tax, so effectively deduct tax at source for money that's received from offshore, while we don't have to from money that's received onshore.
Right.
Now, it may well be that the offshore investors can recover that tax, but it just makes life more complicated.
Right. Okay. So one final question before I let you go. We, at the AltFi conference this week, there was a lot of talk about the Lending Club IPO, which surprised me considering it's actually a US company and not available really to UK investors. So, but the logical question now is you are the biggest player in the UK, and you just took on another round of funding relatively recently. What can you say about a Zopa IPO?
Well, we don't have a plan, and we believe that the business has. It's extremely well funded at the moment, so we're not looking for any money. So it's better funded than it's ever been in its history, and the business fundamentally doesn't need any funding. We're in that nice position of not really needing funding and being very well funded. So that wouldn't be a reason to IPO. We don't have shareholders who are today requiring liquidity. So I actually think we're better off continuing as we are as a private company.
Right.
How that pans out, I don't know. I think the reason everyone's interested and excited about the Lending Club IPOs is it's another stage in the industry's evolution.
Right.
And in the same way that, the Eaglewood securitization of loans last year was another stage in the evolution of the business.
Yeah.
Businesses turning profitable is another stage in the evolution of the businesses. All these things are terrifically helpful, I think. Right. Even if you don't directly participate in them yourself. So we had nothing to do with Eaglewood securitization. In fact, nor did I'm not even sure was it Lending Club paper or Prospect paper?
Lending Club.
No. I think that's generally good for the industry because it shows that it's being perceived differently.
Right. Okay. Great. Well, thank you for your time today, Giles. Appreciate it. Okay, that concludes our UK series of interviews. I hope you enjoyed it. I think you should have now a better feel for the UK market and those leading players. So next time we will be back in the US. Thank you very much.